Hello friends, welcome to CEC Gurukul Live Lectures. Dear friends, today in this session we are going to continue in our series on behavioral finance. Dear friends, this is the last lecture in the series and today we are going to talk on herding behavior, mean reversal and noise trading. And for the discussion on the topic, we have with us in our studios Dr. Divya Verma Gakkar. Dr. Divya Verma Gakkar is Assistant Professor in School of Management Studies, Guru Gobind Singh IP University. Dear friends, we know that you always are delighted to have our expert with you because you always get in-depth knowledge through her. She's a prolific professor and she always add on excellent examples which helps you out in understanding various topics in detail. Friends, if you wish to ask questions from Dr. Divya Verma Gakkar on today's topic, feel free to talk to us through our toll-free number. Our number is 1800-110-430. I repeat, our number is 1800-110-430. Now, I would like to welcome our guest, Dr. Divya Verma Gakkar, once again. Hello, ma'am. Welcome to the lecture.
Thank you, ma'am. So, dear friends, today we are going to talk about three related topics in the area of behavioral finance: herding behavior, mean reversal and noise trading. So talking about herding behavior, herding is, as we all understand, herding is when people tend to follow each other and want to remain in the crowd. So as a human nature, we all our sociology and our social setup tells us that since evolution, human being has always tried to remain in groups and we have always tried to follow collective behavior. So there is a societal collective behavior which exists. So within that framework only, as a human being, we have developed this tendency that wherever there is a group which is following a certain pattern, each one of us try to be a part of that group. Nobody wants to feel isolated. Nobody wants to feel out of the group. So that is what wherein the concept of herding comes from. So herding is a behavior which leads to bubbles, crashes, bull phase, bear phase during in the stock market. So this herding behavior we have seen at various instances in various phases in our day-to-day life as well. If you see small kids, you will find that they try to copy each other. They try to look at that my friend has got this thing, I would like to buy this particular toy, or I would like to enroll for this particular course just because your friends are enrolling in some set of specialization. So you try to, as a young child also, you try to follow the crowd, or you try to be where your friends are, or be where the society is going. So similarly, we have also seen that all the marketing firms who are advertising for various products, so they would advertise it in a manner that that this particular product is liked by everyone. Everyone is buying this item. So that's how they try to promote an item, that the sales is going up for this commodity. So people try to buy that commodity. So once we see that a particular brand is liked by people, so you will find that the sales for that brand will improve, because a lot of other people will join the group just because their neighbors, their friends, their colleagues, they have that particular commodity in their house, so they would also like to buy it. So marketers do play a very, they try to encash upon this herding attitude of people. So similarly in the stock market also, or while investing our money also, we have seen that people do follow the herd mentality. So herd mentality is like whenever we are investing our money, so each of us would like to talk to our social framework which we are involved into. Like we would talk to our colleagues, we'll talk to our neighbors, our friends, our family members, or somebody who's expert in investments. So we would like to see that how are they investing their money, what type of instruments they are putting in their money, how many, if you see that everybody is buying fixed deposits and putting their money in bank accounts, so you have a tendency that since everybody is putting their money in bank account, so there must be something very good, good kind of returns they must be getting in bank account. That's why people think that since everybody is buying, so let me also be a part of it. Otherwise, I will miss something in life, or I will miss some good part of the returns. Similarly, when you see that some people or advertisers, they advertise in a manner that mutual funds are so good, or you find your friends are buying mutual funds, so you happen to have a positive inclination towards buying mutual funds or investing in stock market. So those people who are very regular investors in the stock market, they also look at where their friends are investing, where the broker is telling them to invest, or where their consultant is investing, or some of their known people in their family or relatives or colleagues, where are they investing. Based on that, you decide your choice of deciding that which shares you have to buy. So herd mentality is very common in human beings, and we see it in all type of phases. In every stage of life, we see that people are following the herd. Now, stock market is very greatly affected by this herd mentality, because a lot of investment in the stock market is rational, but there is a lot of investment which is irrational as well, where there is no explanation given by mathematical models that why it is happening. Why suddenly one fine day we realize that stock market has gone up and it is into that bullish phase, and it is going up and it is not stopping, and it is crossing all levels of going up. So just because some people started buying the shares and the stock market prices started rising, everybody else felt that we should also be a part of that group who's buying the shares. Because maybe those people who are buying the shares, they have some hidden news which they don't have, which others don't have, and they just try to follow the crowd, or they try to follow the herd. So that is how, when bullish phase comes, so when few people start buying, everybody else follows them, the herd mentality comes into picture, and that positive sentiment is built up, and you see that there's a bullish phase which runs for quite a long time in the stock market, which is very favorable for the market. Similarly, a bad news comes in the market, and because of that bad news, some people or some experts, they start selling the shares, or you realize that FII has sold the shares of certain companies. So if you have some idea about what is the news because of which people are selling the shares, that's fine. But otherwise, many people have the irrational set of investments. So what do? They would simply see that if FII is disinvesting, is selling their shares from the market, so maybe there is something which they do not know, or there is some bad news which is going to come. So because of that, they do not want to feel isolated, and they also start selling. And like this, the bearish phase starts in the stock market, and prices keep on going down for many days altogether without any explanation or justification by to the experts that why it is happening. So that is a kind of herd mentality which exists. So as human being, we follow the herd mentality. We have that herding behavior in our attitude, because of which we always try to be convenient, and we always try to look at those people whom we feel are expert in their own field, and we try to always compare ourselves with them. So greed, fear, envy, so these are some common human emotions which lead us to herding behavior. So herd instinct is a mentality which is characterized by a lack of individual decision making or thoughtfulness, causing people to think and act in same way as majority of those around them. In finance, herd instinct relates to instances in which individuals gravitate to the same and similar investments based almost solely on the fact that many other investing in those stocks. The fear of regret of missing out on good investment is often the driving force behind the herd instinct. It is also known as herding behavior. Such investor behavior can cause large unsubstantiated rallies or sell-offs based on seemingly little fundamental evidence to justify. So herd instinct is primary cause of bubbles in finance. For example, we can look at the dot-com bubble which came in late 90s and in early 20s, which is one example of ramification of herd instinct in the development of industries bubble. Financial behaviorists attribute this to the natural human tendency to fear of being left alone or fear of missing out. So Banerjee defined herding as everyone doing what everyone else is doing, even even when their private information suggests doing something quite different, but still people would like to do it. Bikhchandani and Sharma have also talked about herding behavior. They argue that investors can be considered to be a part of a herd if they are conscious of and influenced by the action of others. The authors state that investor is herding if the information of other agents investing in the product cause the investor to change his or her decision from not investing to investing in the product. The opposite scenario, when the investor already made an investment without knowledge of other investor decisions and changes his mind after learning that others have decided not to make that investment, is also an example of herding. Wang and Salman defined herding arise when investors decide to imitate observed decisions of others or movements in the market rather than follow their own beliefs and information. In the field of behavioral finance, herd behavior is frequently used to describe correlations in trade as a result of interactions between market participants. Humans naturally want to belong to a community, a group of people with shared culture and socio-economic norms. At the same time, people still prize their individuality and sense of responsibility for their own welfare. However, investors can sometimes be induced into following the herd, whether it is buying at the top of a market rally or going over the cliff in a market crash. Now, herding is very natural to us. It could also come down to the raw, powerful emotions of fear, greed, envy that drive people to irrational state of minds. In financial markets, a bubble is a result of rapid increase in the price of shares more than its intrinsic value, which further supported by active market behavior with positive feedback in a cyclical manner. Now, this bubble continues to inflate till the time investors are ready to pay higher price for the asset. When no buyer is available at a higher price level, then the bubble begins to collapse. So the dot-com bubble in 1990, which was a result of cheap money and easy capital resources, speculation and market overconfidence, bursted like that. Some bubbles start organically, while when there is optimistic view of investors about an asset, and others also join so that they are not left behind in the earning profits, and eventually speculators are attracted and they drive the price to very high levels. So the herding instinct can make an investor apply for IPOs without even looking at the company's fundamentals. Just as the market peaked, investment capital begins to dry up, which leads to bursting the bubble. Now, herding behavior is irrational and driven by emotions, showing greed in the bubble and fear in the crashes. So, whenever there's a crash, a bubble bursts. So that means the market is having a feeling of fear. So because of that fear, people start selling, and because a lot of people are selling, others also join them and start selling, because they feel that if they are selling, they must be having some extra knowledge than us. That's why they are selling. Now, what is the impact of herding in financial markets? When stock market displays volatility, give more than expected returns than fundamental, it raises a concern over the efficiency of the market and reflect herd behavior. Various crises have been caused by herd behavior. Practitioners and economists are interested in herding because it has behavioral effect on stock prices, including some of the following things which we'll discuss now. Now, herding affects risk-return characteristics of assets and have an impact on the asset pricing models. Practitioners are interested in understanding herding as it might create profitable trading opportunities. Investors' herd are powerful enough to move prices away from their fundamental value. Now, because of herding, investors will need more number of securities that create a lower degree of correlation to reach the same degree of diversification. For portfolio managers, as correlation of stock increases over time, because of buying and selling the same stock increases, so on an uptrend day, more buyers are attracted and they will take the market further up. So momentum strategies become more attractive and pricing bubbles and corrections become more extreme in those cases. Now, we have also seen that corporate financial practices also follow the herd behavior, and we follow the peer group, while declaring, like companies when they're declaring dividend, when they're going for mergers, when they're changing their corporate, they're doing their capital restructuring. So they always look at that what other competitors are doing. So finance managers, they try to follow the peer behavior rather than stand alone in the market practices, because they are scared of that in case their decisions go wrong, then they'll be termed as inefficient managers. Now, there are two types of herding. So there are two ways how we can classify herding. One way of classification of herding is into intentional herding and spurious herding. Intentional herding is, in this type of herding, investors imitate action of others and it leads to inefficient market outcomes. Spurious herdings, in this case, investor groups face similar information sets and decision problems which leads them to take similar decisions. This is an efficient outcome. Another classification of herding behavior, as suggested by Devenau and Welch, rational and irrational herding. So second way of classifying is rational herding and irrational herding. Now, rational herding is, it focuses on external environment, assuming that decision becomes misleading because of incentive issues or information difficulties. So there are three reasons why there will be rational herding. One is imperfect information, concern for reputation, and compensation structures. Now, first reason of herd behavior is imperfect information, also known as information cascades. Information cascades are the most general explanation of herding. Information cascades are very fragile and shocks can disturb them, like new entrants and new information. Second reason for herding can be because of reputational concerns, and this has been explained by Sharsten and Stin. They demonstrate that it is rational of a manager to mimic the investment decision of others, as managers can be classified as either smart or dumb. This has been explained in a way that all managers receive information which can be true signals or noise signals concerning an investment decision. Now, the signals of the smart managers are assumed to be correlated, whereas the signals of the dumb managers are not. Any manager will not know whether they are smart or dumb till the time their investment decision of all manager is not visible in the market. A manager will be known as dumb if his bad investment choice is revealed and no other manager has taken similar decision. But if all managers' investment decisions turn out to be bad, then no one will be dumb. As a result, it can be attributed to bad investment climate. So managers do not want to stand out alone in the market and they try to copy each other. Third reason is based on the compensation structures. Now, there are situations where investment managers' compensation depends on how their performance is in comparison to other professional managers. So they have an incentive to copy others' behavior and indulge in herding so that they are not proved to be an inefficient one in case their decisions come out to be wrong. Second type of herding is non-rational herding. Now, this type of herding focuses on investor psychology and assume that investor behaves like imitators, ignoring all rational analysis and following others blindly. Now, when there is large stock market decline where many investors react instantaneously and sell their stock to avoid losses as they know that this is the usual behavior of everyone, this is a situation where investors ignore all rational analysis and react in panic. Now, this can be found in situations of bank panic and other financial phenomena as well. In the literature, there are a few models of irrational herding. Relationship between dispersion and the equally weighted market return is used as a measurement of herding. Another example which comes to my mind related to herding is the recent case of demonetization. As we all remember that 2 years back when demonetization happened in India, so one fine day we realized that some currency has been out of circulation. So it was defined to everyone that all those who have their old currency, they can go to the bank and get it converted, and the supply of the new currency for next few days was really short. So even if somebody was needing money or was not needing money, we saw a situation of panic and fear in the mind of the society as a whole, and we realized that everybody is going to a bank branch, or one person in one family was at least going to a bank branch and standing there creating a queue for long hours just to withdraw some money in cash in the new currency, just because they were having that fear that maybe they would require, even if they do not require money. And government was promoting that you have to use electronic medium of transfer of payment, use debit card, credit card, or other sources of online making online payments, and has launched a lot of other schemes, payment options in the online medium like Bheem app and all those stuff. So, but still there was a situation of panic. Even if we do not need money, we see that our neighbors or our friends or our colleagues are every day somebody is going from their family to a bank branch and standing over there for 4 or 5 hours to withdraw the money. So we feel that we may not feel we are not missed out, and there is something which we are not doing usual to others. So that's why we should also go to a bank branch and stand over there and withdraw the money in cash, or deposit our fund, or you just have to go to a bank branch just because everybody else was going. So there was a lot of panic and lot of and all that which happened, we all know it happened, most of it because of the herding behavior rather than some rational requirement of funds by the people. So the rational investor choice shows that there is a linear relationship between dispersion and the equally weighted market returns. But the presence of investor herds show a non-linear relationship. A negative relationship between dispersions and the market returns will indicate the presence of investor herds. Now what are the reasons of herding behavior? There are various reasons of following the herd, as it gives a sense of conformity. There can be synergic effects when large groups follow the same investment choices, and other reasons can be that psychologically human beings since evolutionary stage has always stayed in groups and moved collectively. So staying in group is a part of human instinct, so we like to follow the human instinct and follow the herd behavior. When people move in groups, so whatever went wrong or right happens, it is for everyone. So no one wants to be pointed out as a loner. It saves you from criticism and evaluation by others just because you are a part of the crowd and you are doing whatever everybody else is doing. People moving together and crowds provide a lot of information about investment and shows general liking and disliking of the society. Like we always prefer to eat in those restaurants which are crowded, as it gives an information that this particular restaurant where there is a lot of crowd is offering good food. So that's how we take our eating out decision. Now, what are the strategies to avoid herd mentality? Retailers and sales professionals definitely use this information to their advantage. They give credence to the high pressure pitch that everybody is doing it, everybody is buying our product, so you should also buy this product. But it is important to be aware of our natural tendency to adopt the herd mentality when you are on the buying end of the transaction as well. How to strategies to avoid herd mentality when we are talking about which smartphone to buy or which software program to use, or choosing a product based on your observation of what other people are buying. It may not be a wisest way of deciding or decision making. So there are few strategies which one should adopt, where simply you should not get into the social default and you should try to make your own choice. So first one is that you should think before you follow. So people have a natural tendency to follow the social default. Now this is a stage when you stop thinking about your options and simply start copying what others are doing. So one should always think before you try to follow everyone else. Form your own opinion. One must gather some knowledge about the market and form their own opinion instead of mimicking others' choices. So take a well-informed decision is a better strategy. Spend time to take decisions. Never feel a pressure of making a hurry. Spend some time analyzing the alternatives and then take a decision. Not everyone who takes quick decision knows the best and has studied about it. So one must study and analyze the things before taking any decision. Be aware of ways in which stress affects your decision making. So when an individual is stressed with any issue in his life, the chances of copying others' investment decision increases. So the times when we are anxious or we are in a lot of stress, it is always possible that our decision making abilities at that time are not very good. So people do not try to take another level of stress and try to take a decision. So they simply try to follow others before rather than taking their own decision. And one should be willing to stand out. When we are following the crowd, we do get social acceptance, but one should also listen to their own heart, or they should understand what are their strengths and weaknesses, and based on it one should decide that how you can take your decision. So if you take your own decision, it may be possible that you stand out. Many people may not like it, but then even if you are a contrarian investor or even if you are a contrarian decision maker, successful people do not stick to the crowd and they take their own decisions, and because of which they will earn good returns in the market. Talking about another topic that's related to behavioral finance is mean reversion. So mean reversion is a concept where we understand that in stock market the movement of prices of shares of companies will come back to the average. So mean reversion theory defines that prices move back to the average value. So it's just like coming back to the equilibrium. So this average can be a historical moving average, growth of the economy, or industrial returns. So even if market is going too much up or too much down, it has a tendency of again coming back to the mean values of the past returns of some long duration. Now, this theory has led to many investing strategies involving the purchase and sale of stocks or other securities whose recent performances have greatly differed from their historical averages. A reversion affects the returns of any value back to previous levels. So mean reversion is that any price that goes away from the long-term value will give return again to that level. The theory focuses on reversal of only relatively extreme changes, as normal fluctuations are an expected part of the paradigm. Even with extreme events, it is possible a security will experience a mean reversion. As with most market activity, there are few guarantees on how a particular event will or will not affect the overall appeal of a particular security. In statistics, regression towards the mean is a phenomena in which a variable which is on extreme on its first measurement will go closer to the mean on the second measurement, and if it is extreme on the second measurement, it will move closer to the mean on its first. So regression towards the mean is also known as reversion to the mean or reversion to mediocrity. Jeremy Siegel defines financial time series as in which returns can be very unstable in short run but very stable in the long run. In this, standard deviation of average annual returns decline faster than the inverse of holding period, implying that the process is not a random walk. But the period of lower returns are systematically followed by compensating periods of high returns in seasonal businesses. Mean reversing trading tries to benefit the investors by capitalizing on extreme changes of prices of two securities based on the assumption that price will come back to the mean level. The phrase reversion to the mean refers to a statistical concept that high and low price are temporary phases and a price will come back to its average over time. Now, mean reversion suggests investors to follow the steps to trade in the stock market. Now, investors can identify an average price over some past period. Then they can define the highest range and the lowest range. Now, one can buy when the price are on the lower side and sell when the price goes on the higher side, that's towards the higher level. So, when the current market price is less than the average price, stock is considered to be attractive for purchase, with the expectation that the price is going to rise at least to the mean level. And when the current market price is above the average price, the market price is expected to fall. In other words, deviation from the average price is expected to revert and come back to the average levels. So, mean reversion has an appearance of more scientific method of choosing stock buy and sell points than charting, because precise numerical values are derived from historical data to identify the buy sell values rather than trying to interpret price movements using charts, also known as technical analysis. Now, there are some asset classes such as exchange rate are observed to be mean reverting, but this process may last for years, so it is not useful for short term investors. Now, mean reversing trading ideas are very simple, but there are obstacles in following the same. So, determining the average ideal time period to calculate the average. Now, what should be the time period for calculating that mean value? It is a difficult question to answer. That what is the ideal look back period? How long is the long term? The look back period will be used to define the averages. Deciding this period becomes very crucial. Securities prices may not be normally distributed. While studying the price trend, we look for some basic assumptions to be fulfilled, like the chart should be normally distributed, and which can be really difficult to determine. It may not incorporate actual behavior. There can be some information about a company which may permanently affect the stock prices. So, mean reversing model may not always reflect true value, like bankruptcy news, stock split, etc. Now, what is the model of mean reversion? A continuous mean reverting time series can be represented by a Ornstein-Uhlenbach stochastic differential equation. So, this equation theta is the range of reversion to the mean, mu is the mean value of the process, sigma is the variance of the process, Wt is Wannier process or Brownian motion. So, this is how we try to decide that the mean reversion value. Now, in a discrete setting, the equation states that the changes of price series in the next time period is proportional to the difference between the mean price and the current price with the addition of Gaussian noise. The mean reversion process is a log normal diffusion process, but with the variance growing not proportionally to the time interval. The variance grows in the beginning, after some time stabilizes on certain value. The stabilization of variance is due to spring-like effect of the mean reversion. Now, this picture shows the low price case of mean reversion, and you can see that this low price mean reversion values are plotted on a normal distributed curve. So, at any point of time, the normal distribution curve is matched with the actual prices, and then you try to identify the value. There is another graph which can show you the mean reversion of high prices case. Now, determining just when prices have been stretched too far from its average and how far back to the mean it will travel when it does revert is more of an art rather than a science. So, that is why, even if you are trying to evaluate that whether it is you have taken moving averages and you are trying to see that whether this level of price is near to the mean, is above the mean or below the mean, to understand that whether you should buy at this time or sell at this time, depending upon what is going to give you more profit. Now, this is more of an art rather than a science. So, understanding these curves and evaluating that whether you are taking the right decision and what is the mean reversion value. So, that comes more with practice. So, the idea behind mean reversion in a nutshell is that a moving average of share price represents the accumulation of wisdom on the fair market value of a particular company's share, while the day-to-day fluctuation in the share price is more a reflection of ever-changing whims of market sentiments. So, day-to-day prices are like market sentiments, and the long-term value shows how it is being perceived by the people the company is being perceived. Thus, whenever that sentiment drives share prices too far from its average, the efficiencies of market forces being what they are, share price is bound to revert back to the mean in the short order. Now, talking about herding, and so herding is very common in all financial market, as we all understand. Herding leads to formation of these bubbles, buy and sell trends. So now if somebody is buying or selling and you look at the mean reversal figures, I think mean reversal concept propounds that price can come back to the mean after some time. So even if because of herding prices have gone up or has gone down, again it will come back to the average level, and that you can determine. So one should not feel scared about the ups and downs of the stock market, the bulls and the bear phase in the stock market. One should not get into panic and try to see, look at the mean values and try to see that how much price has gone down or has gone up, and depending upon that decide that in future it is going to come back to the mean. So based on that mean reversal concept, and then decide that whether they want to buy, what would be the right time for them to buy or to sell the shares in the market. Now another related issue with the herding behavior is noise trading. Now noise trading basically is the noise element in the stock market. Now noise is something which is a confusion where we do not know what is happening, what is being discussed, who's creating it, whether it is true or fake. So that is all that information which is coming into the stock market, all that prices which are moving just because of no reason. So all that is termed as noise. Now we always see that in mathematical equations where we have a Kappa model or we have a Farmer-French model. With that model, with the whole equation, we see that there is some unexplained part or the residual value of the regression equation which we can't explain. Even the mathematical models show it. Now they have termed it as that mathematical value, that E value which is shown in the Kappa model or in the Farmer-French model or in the APT model, and the end which is added, that is the residuals, which is unexplained part of the market behavior, which is termed as noise. So this noise is the irrational investors who disseminate information, who are talking about taking decision based on some information which is noise, which has no logical foundation in terms of that whether the information is true or not, but just because of, and this noise can happen because of herding as well. So this noise can come because of herding also, that there are certain players in the market who are creating noise, who are showing, who are displaying certain type of behavior in terms of buying or selling certain shares, which is unexpected, unexplained by the market fundamentals and unexplained by the information which is already existing in the market and is not being understood by the rational investor. So that is something called irrational investor sentiments because of some behavioral biases, because of some other emotions or some irrational decision making. These noise traders, they enter into the market, they affect the market for a short period of time, and then after that the things stabilize and come back to the normal level. So that's what noise traders are all about. So in the classical finance also we understand that arbitrageurs always behave rationally, and when it comes to decision making, they try to maximize their wealth and take optimal decisions, and hence their portfolios are efficient. But whereas behavioral finance says that arbitrageurs are influenced by psychological and number of extraneous variables that lead them to behave irrationally and thereby discourage market to be efficient or make future returns highly unpredictable and uncertain. So noise traders usually take irrational decisions in the market. Noise traders are those investors in the market who make buy, sell and hold decision without using fundamental data, and they end up taking irrational decisions in the market. They can have a poor timing in the market. They follow the trends and they overreact to good and bad news. So overreaction is also one way how noise traders try to reflect that they are present in the market. So the presence of noise traders in the financial market can lead to changes in prices, risk levels to diverge from the expected levels. They create market anomalies and risk for other investors who take decisions based on fundamentals. Noise traders do not filter real information signals from noises, and they also create their own noise. So one noise trader or many noise traders will become more noise trading. So a lot of other people who are following the herd will also attracted to these noise traders and will join the suit without even evaluating that why these people are buying or selling or holding the shares of certain companies. So they will create more noise in the market. So the concept of noise trading was introduced by Fisher Black in his paper Noise, 1986. He found that investors trade on the basis of limited information. So there is cognitive overload of information and related human stress, which makes it difficult for people to focus attention on the most important news or to take rational decisions. Now, noise trader behavior as explained by behavioral finance. Now, there are two theories in behavioral finance. Limits to arbitrage and investor psychology. Black in 1986 termed those investors who do not have private information and behave irrationally as noise traders. Noise traders do not follow expert advice and do their own technical research and believe that it is useful to buy risky assets. It is found that noise traders use incorrect belief and decide their portfolios. Traditional finance suggests that arbitrageurs help in maintaining market efficiency. The markets have both irrational traders and rational traders. These irrational traders make price deviations from their fair value, and rational investors like arbitrageurs help bring back prices to the fair level. But behavioral finance explains that arbitrage is not unlimited, but arbitrage is limited. So arbitrageurs are also risk averse and have short horizons, which also reduces their willingness to take position against noise traders. So this concept is known as limits to arbitrage. So because the cost and the other attributes of arbitrage process are limiting or are making the arbitrager not get into arbitrage process and stand against the noise trader. So this brings the whole concept that why noise trader exist in the market. So ultimately arbitrageurs also follow the noise traders. The impact of noise trading on the market includes that they distort the mean variance efficient frontier and thereby they create abnormal returns to the securities. They create a link between market beta and abnormal returns. They create excess volatility in the risk premium on the market portfolio. They create a gap between subjective volatility implied in option pricing and its objective counterparts. It is observed mispricing of stocks which caused substantial resource misallocation is partially the result of sentiment waves. Noise traders make the market unpredictable and risky. Unexpected boom and burst in the financial sector is a mere reflection of noise trading. Now, behavioral capital asset pricing model. The behavioral capital asset pricing model, BAPM, takes its roots from the capital asset pricing model CAPM. In the stock market, there are noise traders and information traders, and they both affect each other. So CAPM takes into consideration information traders who obey Bayesian rule and do not make cognitive errors and are rational investors. BAPM forces on noise traders in the market who commit cognitive errors, are normal, not rational investors and do not follow Bayesian rules. These two traders define asset pricing through their interaction. When information traders are dominant in the market, markets are efficient, and when noise traders are active, market becomes inefficient. So noise traders can create some abnormal returns to particular securities. Sheffrin and Statement introduced the concept of behavioral asset pricing model. The model calculates the behavioral beta, which is the tangent of mean variance of efficient asset portfolio. Behavioral beta includes noise traders in the model and also represent lower risk than normal beta. Noise traders have positive relationship with abnormal returns and beta. When prices are efficient, this price efficiency protects noise traders and leads to increase in volume. But when prices are inefficient, then new information is not sufficient for taking decisions. Risk premium, term structure, option pricing with noise trader have been studied in BAPM researches. Now, the three-factor model of Fama and French of Standard Finance uses market capitalization and book-to-market ratio as the risk measure. But behavioral asset pricing model provides interpretation of these characteristics of Fama and French model. Stocks which have high book-to-market ratio are small in size, are considered to possess high risk and thus high returns are expected on them. While characteristics such as emotions, representativeness and cognitive bias are considered to represent risk in behavioral asset pricing theories, by considering such risk characteristics, investors can invest in good stocks and thus can earn good returns. Another theory which has been designed with behavioral finance is behavioral portfolio theory, BPT. Just like we have the portfolio theory given by Markowitz. So, Sheffrin and Statman in 2000 gave behavioral portfolio theory. It is known as a goal-based theory. This theory applies mental accounting, where investors divide their money into many mental accounts, layers of portfolio pyramids based on their objectives like retirement, education, and other reasons why they need money. So, mean variance portfolio theory given by Markowitz in 1952 suggests that investors view their portfolio in totality. But behavioral portfolio theory suggests that investors see every mental accounting layer separately with respect to the goals and risk. So, investor design downside protection layer and upside protection layer for himself to become poor and rich. As per this theory, mental accounts can be single mental account versus multiple mental account version of behavioral portfolio theory. In single mental account, investor follows single mental account to manage his portfolio, while behavioral portfolio theory, which is multiple account based, investor use various mental accounts and integrate their portfolios. These BPT investors are same as Friedman-Savage puzzle of investors, where they have both risk averse and risk seeking attitude. Now, investor sentiment index. A lot of countries and economies have tried to develop a investor sentiment index, so that one index value can tell that what is the investor confidence existing in the market, or what kind of sentiment investor is having right now. So, various studies have taken place to understand and capture investor sentiments in the stock market. Many countries have their own indexes, but in India till now we do not have an investor sentiment index that has been designed. But many other countries where, so in these countries the researchers are trying to explain the investor sentiments and through certain variables which are financial in nature, and they have tried to create a sentiment index. So, there are certain variables which are popularly used as a sentiment index variable, which includes turnover volatility ratio, share turnover velocity, advance declining ratio, margin borrowing, buy-sell imbalance ratio, put-call ratio, number of IPOs, equity issue in the total issue, dividend premiums, mutual fund flow, cash to total asset ratio in mutual funds, price to earning, high to low ratio. So, for measuring the effect of irrational behavior of stock return volatility, effect of rational behavior is to be controlled. For this purpose, the selected variables are regressed on macroeconomic fundamentals so that the sentiment index can be defined. Another research study done by Ramaiah and Davidson talks about information adjusted noise model, where they try to capture noise trading of the stock market through the CAP model and using the behavioral beta, and they have tried to do it through the information adjusted noise model. And then Sheffrin and Statman in 1994 used this particular information adjusted noise model as a proxy for noise trading in the market, where market is inefficient. So, the variation in the behavioral errors can be justified by holding external information arrival, liquidity trade constant, and portfolio rebalancing, and the information adjusted noise model extract information from the this behavioral beta. Now, in this way, we have gone through that noise trading has tries to create a noise. Noise traders, they try to create noise in the market, and they are based on very strong sentiments which are irrational in nature, which comes because of a lot of herding behavior, and which comes because of other behavioral biases, cognitive biases, which investors are affected by, because of which we have seen that these noise traders, they create bullish phase or bearish phase in the market. They make the markets inefficient, and nobody is able to explain that why and from where these noise traders have come. And because of these noise traders, the markets goes inefficient, and the relationship is not very clear that why it is happening. So as we know that investors are not always rational and do not follow expected utility theory, and many traders are irrational and they are known as noise trader. So various behavioral finance theories which we have talked about in various sessions, which include prospect theory, then there is a behavioral capital asset pricing theory given by Sheffrin and Statman in 1994, and the behavioral portfolio theory given by Sheffrin and Statman in 2000. The original Kappa model, which helps in defining prices of various assets, ignore the role of noise trader and their cognitive errors which affect the prices. But the behavioral asset pricing model, which includes noise trader influence, give more realistic picture of the market. Behavioral portfolio theory, which focuses on defining portfolios based on layers of needs of investors based on mental accounting. So that also gives a very different opinion on the market. So behavioral finance explain those anomalies which efficient market hypothesis and CAPM is not able to explain. And there's a lot of scope of research for the development in the area of behavioral finance, and there are with respect to various other biases which we have discussed in this series on behavioral finance, related to emotional biases, cognitive biases, role of personality, role of the overall attitude and behavior of the investor, herding. So all of these affect the stock market, all of these affect the financial decision making taken by any manager or any individual in their life. So that's all about behavioral finance. Maybe I hope you have enjoyed listening to this session.
With this note, thank you, and thank you so much for giving precious inputs to this lecture, as well as summing up this entire series on behavioral finance. Dear friends, we believe that you have discovered a lot, and if you want to explore more, you can watch through our YouTube channel, as these lectures are uploaded there. So friends, you can post your feedbacks regarding this entire series on behavioral finance. You can contact us through our email ID, that is info.cec@nic.in. We are taking your leave with the promise that we are very soon going to start another new series, and this series, of course, we will be carrying on with Dr. Divya Varma. Till then, take care, goodbye. Thank you, ma'am. Thank you once again.
Thank you so much.